Section 1. The Dislocation Hook. There is a simple reason the market keeps misreading this story. It is looking at the wrong line. The headline view says, reported consolidated net profit dropped sharply year on year. To the unanalytical eye, a headline fall of over 70% looks alarming, but that is where the surface-level panic begins, and the institutional opportunity opens. The dramatic drop is an accounting artifact. It is a high base effect from the previous year, when a massive one-time exceptional gain of over 15,000 crore rupees was recorded from the hotel demerger process. Once you adjust for that historical noise, the core operating perimeter looks entirely different. Revenue from operations actually climbed roughly 17% to over 23,800 crore rupees. So while the retail crowd reacts to a distorted bottom line, the real economic center of gravity remains insulated. What is emerging here is a calculated transition story, a core tobacco profit pool that continues to anchor the balance sheet, a premium FMCG franchise expanding its operational floor, and a structural corporate realignment that is cleanly separating unlike assets. This is the dislocation. The market is pricing the asset as a burdened, slow-moving conglomerate, while the data suggests it is transitioning into a leaner, higher return on capital compounding platform. Of course, no consumer ecosystem operates with absolute immunity. Macro environmental shifts, unexpected tax changes, and inflationary pressures are live variables. But in institutional analysis, the key question is not whether risks exist. The key question is the durability of the defense mechanism. And when a business can navigate regulatory shocks, scale its margin baseline, and throw off cash without carrying debt, the long-term multiple eventually aligns with those operational mechanics, not the headline noise, the underlying economics. Section 2. The core, anatomy, and elasticity. To understand the strength of this defensive model, you have to look closely at the cigarette business. This is where market sentiment often defaults to a binary fear. It notes changes in taxation and immediately models severe volume damage or structural degradation. The actual dynamics are far more nuanced. Following the February taxation shifts, revenue for the segment rose to over 11,000 crore rupees. Management responded not with blunt, aggressive pricing, but with a highly calibrated intervention, roughly plus 1.5% to 2.5% on select SKUs. This surgical response tells us two things about the franchise. First, it reflects a disciplined understanding of consumer behavior and psychological price points at the retail level. Second, it demonstrates what institutional capital refers to as pricing elasticity. In plain English, elasticity is simply a measure of how sensitive customers are when you change the price of a product. If a minor hike causes demand to evaporate, your pricing power is weak. But if you can nudge prices to offset regulatory friction without triggering a meaningful volume drop, you possess a structural moat. Now, we must be careful not to mistake this strength for absolute immunity. Elasticity is rarely perfectly linear. Aggressive taxation or a massive spike in illicit contraband networks can disrupt this equation over a longer horizon. If legal prices detach too far from illegal alternatives, consumer downtrading becomes a non-linear risk. But the current operational footprint shows resilience. Segment margins sustain their defensive positioning, allowing the core business to fulfill its primary role. And that role is to act as the internal funding mechanism for the entire corporate group. The predictable cash flow from this segment creates the financial runway to execute long-term strategic shifts elsewhere. It means the company does not have to rely on debt to fund its consumer expansion. It means it can absorb cyclical down cycles in commodity-driven segments like paperboards. And it means it can maintain dividend credibility even while capital-intensive structures are being realigned. So when observers talk about regulatory headwinds, they are identifying a real risk factor. But when you look at the actual execution, you realize the core machine is performing exactly as intended. It is absorbing the friction, protecting the return profile, and underwriting the transition of the broader enterprise. Section 3. The Margin Multiplier. Now we move to the piece that alters the long-term duration conversation, the FMCG business. This is where many investors still look through an outdated lens. They remember a division that was high in promise, but subscale, Large in ambition, but not yet structurally self-sustaining. That legacy version is changing. The FMCG Others segment clocked a robust 15% revenue expansion to over 6,300 crore rupees. Operating margins expanded by 200 basis points, climbing to 11%. Many observers treat this expansion as temporary, a passing gift from benign input costs, a cyclical tailwind that will evaporate when raw material trends turn. That interpretation misses the structural shift. While short-term raw material deflation acts as a helpful kicker, the foundational driver here is product premiumization and operating leverage. Premiumization means the mix is evolving toward higher margin categories in foods and personal care. Leverage means the company is spreading its fixed infrastructure costs over a scaled-up revenue base. However, a professional allocator must avoid assuming this trajectory is linear. Fast-moving consumer goods margins are volatile. Unexpected surges in commodity prices, aggressive competition, or a sudden dip in rural consumer sentiment can pressure this segment. Calling an 11% margin an unbreachable floor overstates certainty. Instead, the real insight is that the baseline profitability floor has structurally stepped higher. The FMCG division is increasingly moving from a capital sink to an independent cash-generating consumer franchise. If this operational progression continues, the current sum-of-the-parts valuation framework begins to look unstable. Meanwhile, we must track the cyclical pressure in paperboards, paper, and packaging. Global overcapacity and macro headwinds have weighed on this segment. But in a diversified structure, this drag is cushioned by the sheer volume of core cash flows. The paper business remains a high fixed cost operation navigating a cyclical bottom. It challenges short-term sentiment, but it does not impair the structural integrity of the enterprise. Section 4. The Capital Realignment and Terminal Moat. This brings us to the defining corporate catalyst, the hotel demerger. This is the operational shift that forces institutional models to adjust. Historically, the conglomerate structure carried a persistent valuation penalty. An exceptional, high-return consumer machine sat directly alongside a capital-intensive hospitality asset. The hotel business absorbed significant capital expenditure, carried heavy depreciation drag, and lowered the aggregate return profile of the entire company. The demerger steps away from that arrangement. By transitioning toward an asset-light framework, the company strips out a major source of capital intensity. Once heavy asset metrics are unbundled, the remaining consumer and cash franchise becomes much cleaner to analyze. Now, we should not oversimplify this catalyst. Spinning off the hotels does not instantly eliminate every macro risk or completely erase capital needs. Furthermore, the company is retaining a 40% equity stake post-transition, meaning a portion of the balance sheet remains anchored to hospitality variables. But structurally, the transparency shift is explicit. It allows the market to apply a clean sum-of-the-parts calculation. Instead of discounting the entire company as a complicated conglomerate, institutions can value the segments for what they are. Today, there is an obvious classification dislocation. The market effectively caps the tobacco business within a compressed forward multiplier of roughly 18 to 20 times. Yet scaled, pure-play consumer franchises with stable margin progression are benchmarked at 35 to 40 times. By clearing the corporate perimeter, the path for an incremental re-rating becomes institutionally defensible. This underlying balance sheet durability is why the external credit signals are so vital. Consolidated cash conversion remains structurally protected, a reality formally validated by credit ratings confirming that even during localized cyclical downturns, the entity's liquidity and long-term dividend capacity remain uncompromised. So the complete operational picture becomes clear. The retail market looked at a distorted 72% net profit drop from a historical high base effect and panicked. But sophisticated capital looks at the machine itself, a machine showing near 17% revenue growth to over 23,800 crore rupees, a machine with cash conversion that continues to secure the balance sheet, a resilient cigarette profit engine, an FMCG division hitting an 11% margin milestone, and a demerger catalyst designed to optimize long-term return on capital. The surface friction is real. But for the patient investor, the underlying machine remains one of the most compelling risk-adjusted transition stories in the market.